we have sound? Now we have sound. Oh, my mic was off. Weird. All right, I think you have sound. Yeah, boy! All right. What's cooler than cool? Ice cold. Hey, good morning. Welcome to Trade Non-Farm Payrolls Live. Well, we decided to make this a regular webinar, and this is now month 205. And you're probably thinking, that's more than 17 years in a row without failure. Well, that's how we do. So anyways, welcome to FXStreet, FX Bootcamp, Trade Non-Farm Payrolls Live. Good to see you. We got an exciting day today. We're going to get a headline number. We're going to get some revisions. We're going to look at hourly earnings and the work week and so on and so forth. And then filter this in through what the Fed is talking about. You may have remembered or noticed that we had a FOMC meeting on Wednesday. We can talk about that if you want as well. But now we can take what happened on Wednesday, take a look at what happened now, try to find some congruency or dissonance, and try to make strategic plans around that. Now, why would we want to do that? What's the point? Well, let me remind you that trading is risky, not appropriate for everyone. Your past performance, good or bad, is not necessarily indicative of future results. Please stay small, stay humble, focus on the long term. Never risk money you cannot afford to lose. So it's about, 740 on Wall Street right now. 740. Nice. 740. And so at 8:30, this news will come out. So I think we should take a look at what some of the subcomponents that go into this. First of all, could we get a thumbs up for our moderator, our FXStreet moderator? We have the best moderator ever. There's nothing moderate about our moderator. We have an extreme moderator, extremely good moderator. So make sure you click the thumbs up on the YouTuber thing. If you're on YouTube, right, click the thumbs up and share some love with FXStreet for all they do. Now, my name is Wayne McDonell, and I've been doing this for meaning sharing my Forex trading strategies for about 20 years. And when I first started, the only resource out there for FX on the retail side, remember back then, Forex was just for bankers. So they had all their sell-side research, but as far as information and resources and support for retail Forex traders, there just wasn't anything. And then I searched, and lo and behold, I found the one reliable source of information about FX, and that was FXStreet. And so in my early days, I wanted to share, and they thought it would be a good idea. I did a few events with FXStreet. They were very successful. We were very happy. And I sat down with the leadership of FXStreet, and we said, let's do something remarkable. Let's do something that nobody else is doing. Let's do something that will have a real impact on our audience, a positive impact on our, let's make a difference. That was the mindset more than 17 years ago for creating Trade Non-Farm Payrolls Live. How could we have a positive influence and make a positive difference in retail Forex trading lives? We came up with this crazy radical idea of do a live event around non-farm payrolls, which was, at that time, you can imagine, NFP would come out and the euro dollar would jump 400 pips in 1 minute. Can you imagine that type of volatility? And the second thing is the industry, the retail Forex industry, was filled with scumbags and scam artists that were pitching get-rich-quick techniques. And, non-farm payrolls was great because that crazy volatility would allow somebody to say, look at me, I just made 400 pips in 1 minute. Look how rich I am. Look, models and bottles. I have a yellow Lamborghini. I have a jet. Nonsense. So anyway, we said, well, look, if we can sort of wrap live analysis and education together around this crazy, very interesting, very important event, it will entice people to stay and gain reliable knowledge. And if they're with me and FXStreet doing non-farm payrolls, they're not with some get-rich-quick scam artist. And so it's a double win-win for us. Educate, but also save the souls of lost Forex traders. So welcome. That's the setup for what we do. Yeah. So if you want to know a little about macroeconomics or Forex trading, I have like 20 years of experience trading. Before that, I was a venture capitalist. Before that, I sat on the board of directors for a nonprofit organization in New York City with, somebody called George Soros. That was his name, from the Quantum Fund, former president of AT&T, senior vice president of General Electric, a representative of the United Nations, senior vice president of Arthur Andersen, the largest accounting company in the world, and a few others, and me. So that's where I started. Then I went to the Silicon Valley, became a VC, and then here I am doing Forex. My third career. So here I am, rocked you like a hurricane. So ask questions, get involved, let me know how I can help, and I will do my best. I'm pretty good at technical analysis. I'm pretty good at fundamental analysis. But I have a strong passion for everything money. I'm a capitalist pig dog. I love money because money is the root of all good. Now, you might have no money and you're like, but money is the root of all evil. No, it's not. Evil people are evil when they're poor. Good people are good when they're poor. But the problem is, if you're a good person and you want to do good things, but you have no money, you really get very little done. It's very difficult, it's very slow, it's very inefficient. If you're a really good person and you have tons of money, you can do whatever you want. You can be evil if you want, or you can be epically good if you want. But the thing is, if you're epically good and you have money, you can get things done. That's why it's the root of all good. If you want to change the world, it's hard to do it if you're dead broke, right? If you're trying to put shoes on your kids' feet, put food in their mouth, give them a safe place to live, and that's where all your money goes, it's kind of hard to change the world when you're trying to just get through today alive. Don't you stink? Anyway, so let's do some Forex trading today. This is going to be a good macro day. I'm trying to get this resized. There we go. And then we'll resize this. Okay? So it's going to be a good fundamental day. The Fed may or may not pause. They indicated a potential for a pause, so it's a hawkish pause if we get a pause. It's not guaranteed we get a pause. In fact, if we don't get a pause, that'll be shocking. It's like, I looked yesterday, what was it, 96% chance of a pause? Well, they didn't say they were going to pause. So that's a big bet there. So when NFP comes out, and we're trying to answer the question, will they actually pause or will they raise one more time? That's all I care about. So NFP could show that what they're doing is working, so they can go ahead and pause. But NFP might be surprising to the upside. And, well, there are some indications that what the Fed is doing is working. But this could be one that shows that, well, it's not working in the employment sector. The economy might be slowing down, but boom, 270,000 jobs. You're like, oh my God, okay? And all of a sudden that really puts a giant question mark on the pause. And remember, the right now, the market says pause and pivot. And it's weird because up until now, like, you know, the previous, not the Wednesday's FOMC, but the one previous to that, the Fed didn't even signal a pause. And a pause and interest rate cuts were priced in, like 3 or more cuts. So now there's almost 100% chance of a pause, and there's still rate cuts. Now, here's the thing. The 2 meetings ago, they said, well, we're not even thinking about a pause. Or, we haven't got to the point where we want to pause. And now they say, well, we could. There's a lot of things starting to work, so we could. We're close to that point. But did he say it was going to happen in June? No. It's 100% priced in. So he hasn't even really said they're going to pause. He could, but he hasn't really said it. But there's cuts priced in. Cuts! And this meeting and the meeting before, Jay Powell actually answered the question of, will you cut by the end of the year? And he's like, no, we're not. And yet it is priced in. So this is what we're dealing with right now. The way that NFP comes out could lead us to keep those cuts priced in, or we need to unprice those cuts. And I'm in the unprice those cuts camp. What do you stink? Smell like a plan? Huh? So let's spend some time on that, and then we'll dive into the NFP stuff, okay? There's a lot that we could look at. I want to do the Fed Watch tool, so let's start with the Fed Watch tool. But I should open up some quant box. We can get our quant box going. Quantbox.co. Let me log into quantbox first. Beep, 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 beep. Biddy-dee, biddy-doo, biddy-doo. Isn't this like one of the prettiest things you've ever seen? I know, right? Macroeconomics training, quantbox training. Yeah, nice. All right. Can we go into Pro? Log into the database. We're logging into the database. Yeah, it's not a website. This is the Google Cloud. Oh, snap. And we're dynamically creating everything from live data. Generate. Boom! So we should probably go into the old scatter plot today. Just as a quick opener here. Let me expand our minds. Boom. So the biggest winner today, oil back over, look at that, right now, oil back over 70. It's cray. That thing just dropped off the face of the earth, huh? Wow, so we're all the way back up, 2.89%, biggest winner. Aussie Swissy up, CAD Swissy up, Pound Swissy up, Kiwi Swissy up, Euro Swissy up, Dollar Swissy up. Smells like risk on to me. What do you stink? Okay, DAX is up, FTSE's up, ooh la la. Okay, so what's heading down in a blaze of glory? Okay. Gold at the all-time high, but down 0.5%. So you hit the all-time high and stop. Nazi's way down today. Although what? Apple reported good, right? So what do you think? Were we going to have a pop on Nazi this morning? Yeah. Okay. Bitcoin still farting around 29K. Okay. Nice. So anyways, Swissy is weak, showing risk on stuff. We can organize these trends, and what would you like? Okay. Swissy has been in a downtrend. Right, USD Swissy has been in a downtrend technically. See, this is technical trends. So we're in a technical downtrend for USD Swissy, technical downtrend for CAD Swissy, technical downtrend for Euro Swissy, technical downtrend for an Aussie Swissy, and yet all those things are up today. So either a reversal in the trend is being developed, or those are all out of position trades, meaning, right, that those things are up today but down tomorrow. How do you get that information? Let me hang on. Let me get you something. Hang on. Hang on. We're almost there. Patience, grasshopper. Patience, grasshopper. I have a link I want to share with you. All right, it's this link. Let me get this. And I believe the moderator allows me to share links. Yeah. All right. Oh. Hang on, now I gotta move my thing so I can hit the send button. Does that actually... No, there's too many. Hang on. I can get rid of the thing that says free webinar. I don't know if this will actually give you the link. Oh, it's still too many. Hang on, I'm working on it. There's limitations with posting on YouTube. Hang on. Okay. And then I have to get the re-get the link and post it this way. There we go. Free webinar. I just had to type that in. See, I can't do two things at once. Okay. So there's many different resources that you know, how do you say it, that I've created or represent to foreign exchange traders. One of them is my education and training community. That's FXBootcamp.com. That's probably where you know me from. I also recommend Trader's Way as a foreign exchange broker. I believe they're an ethical, trustworthy foreign exchange broker that would like the opportunity to earn your loyalty and your respect through world-class customer service, fast execution speed, huge swaps, but they also don't screw around with your trades. They actually enter your trades in the interbanking system. QuantBox is one. QuantBox is my service that, quote unquote, uses AI sitting on the Google Cloud to gather and compare macroeconomic data from public and private, you know, like government type databases, pulls that all information through, organizes it properly, scores it, and then does comparative analysis between multiple economies to produce a macroeconomic bias. That's what it does. So anyways, all those resources are available to you. So quickly looking at our scatter plot here, if I go big again, this is simple. What you want to do is look at this. This is statistical analysis of this data set. Of course, these are asset prices. And so we're going to split this into quadrants because you can see it's not perfect. You can see there's more things above the zero line than below. So you can see there's, in this distribution. But the way that you look at this, if you don't want to think of it as calculus, think of it, oh, wait, you can't see it. I have to move this out of the way. Hang on. I can do that. All right, cool, right? All right, so now we're looking at this. So let me put it back. If you don't want to think of it as calculus, because if I mention the word calculus, your head explodes. So do it this way. Do you remember back in 5th grade, maybe? They said, hey, a positive times a negative is negative. A negative times a negative is positive. A negative times a positive is negative. And a positive times a positive is positive. Do you guys remember that nonsense? And you're like, what the heck is this? Well, it's actually, they're setting you up for calculus. And statistical analysis leans on this. So you want to look at, the distribution of your data set here, and you break things. And what this scatter plot is doing is the market change that's actually occurred relative to what the economic score of these asset classes are. So think of it this way: what should happen versus what has happened. And one way to play this is you have to understand that everything up here is up and is expected to be up. So these are all your winner chicken dinners for the day. That was supposed to happen quantitatively. But we know what should happen is irrelevant to what is actually happening. Well, that's what we're trying to do, is separate. So everything over here was expected to be up, and it is up, and you are expected to be making money on that. Now, everything over here is expected to be down and is down. So that everything is right as rain. Now, this stuff is up, but it wasn't. So you see, these are all those yen pairs, Swiss franc pairs that we went over in the market scan. Everything over there is up, okay? Aussie Swissy, Kiwi Swissy, CAD Swissy, USD Swissy. See how you get this information? Quick though, snap like a crack of a whip. I attack front and back in this thing called Quantbox. Okay, so you're like, dude, look at that. You don't have to sort through tons of data anymore because we have all of this data. We've gathered the data. It's in a data table. The data set is in and we organize it in a scatter plot. So visually you look at this, you're like, ooh, all of this is wrong. It's up, but it should be down. Remember, positive, it's up, but negative because it should be down. So here's what this is telling us. And this is real time. So it's like these things are up today, but if they're supposed to be down, then maybe you should be looking for opportunities to sell these things today, not buy them. We don't know that to be true. Maybe the trend has changed. Maybe something fundamental has changed. Maybe the central banking policy has changed. Something may have changed. But we're still looking at comparative analysis of macroeconomic data to what you would expect and then what is happening. And so there's either a huge reversal going on or you're going to be selling everything up here later today or tomorrow or next week. These are out of position, OOP. Same thing, everything down here is negative today, but they were supposed to be positive. So negative, right? They're negative, but they're supposed to be up here with the winners. So gold is down, but maybe it should have been up. Well, we know it's hit an all-time high, massive profit taking, massive psychological level, but QuantBox doesn't have a psychological level. It's an algorithm. It's doing comparative analysis, right? So anyway, so maybe those are your buys later today, tomorrow, next week. You know what I'm talking about? Because like if we look at Aussie Swissy, it's a cross pair, and we got to go Aussie Swissy. Okay, it's got a technical bias down. Okay, COT is neutral. Retail sentiment favors the Swissy. Seasonality favors the Swissy. The technical trend favors the Swissy. Inflation favors the Swissy. Unemployment favors the Swissy. The only difference is GDP and interest rates. So, right? So neutral, bearish, 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 bullish, bearish, bearish, bullish. There's still more forces pointing this down, yet it's up today. So if you were at a psychological level of maybe like 0.6000, and then you see it roll over, maybe you're more interested in selling it than buying it or being neutral. What do you think? Cool, right? I mean, look at this. Let me put it back. Oh, now my camera's in the wrong way over here. Okay. See, institutional investors, they're 60% short Swiss franc and 61% short Swiss franc, 63% short Aussie. So an institutional investor is not even trading this. They're more short. They're short both of these things. And yet retail traders are long. Huh? 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 What? Look at retail. Where are we looking at? Aussie Swissy? I missed it. There's a euro. So Aussie Swissy. Look at that, huh? So institutional is short both Aussie and Swissy. So really, they're not trading that pair. But then when we look at Aussie Swissy on the retail side, 78% are long. Ha! It's quite a mismatch, you see? Institutional investors are like, pass, and yet retail is heavy long. Oh. Oh, really? So there's a bit of a mismatch, probably, right? You see what I mean? Got to know this stuff. Institutional positioning versus retail positioning. You got to know. Lovely. All right, so let's get to the next thing I want to look at. Fed watch, toot toot. Toot toot away, pop pop, toot away, pop. Shiggly, a shiggly, a shiggly, a shake. A shiggly, a shiggly, a shiggly, a shake. Toot away, pop pop, toot away, pop. All right, where to go? Where to go? Oh, it's back over here. All right, so speaking about institutional positioning, let's take a look at positioning by banks. The next Fed meeting is June 14th, and there's a 98% chance, according to this constituency, let me put that over there, sorry, that the Fed does not raise interest rates. 98% chance. Is it possible that they're wrong? Oh, for sure. Oh, for sure. Oh, for sure. Okay? Oh, faux show. Yeah. What do you guys think? Pause or no pause? How about this? Why don't you type in the chat, pause or raise? Let's do an informal survey in which you actually have to click the keys on your keyboard. Pause or raise? Pause or raise? Pause or raise? Okay. Now, if your answer is raise, I think we're going to make a lot more money than if they pause. Coyote puts neutral. Oh my God. Darko says, what does the dot plot say? The dot plot is already old, and we don't get a new dot plot. We don't have a new dot plot. That's all I can say. So I think the June one does have a dot plot. So we're going to be updated, right? But no, so we don't know. By the way, Coyote says neutral. One of the first things you learn going back to university. So in my 40s, in my mid 40s, I went back to university for 5 years. So I guess my early 40s. I went back to university for 5 years as a full-time student in a dual degree program. And one of the things you relearn as a student is you have to answer the damn question. And so if I say type in pause or raise and you type in neutral, that wasn't the question, right? It's pause or raise. And so I know what you mean. A neutral would imply pause, but that's not what you put. So anyways. So Darko says, okay, raise, no pause. I was watching the live Fed press. Yeah, for sure. Okay. So we don't know, actually. We don't know, but that's what today is about. So in reality, we know that what is priced in. So Coyote, right? Like and for everybody else too, like if you ever wonder when somebody on TV or says, oh, it's priced in, there's two things that means. One, they don't know what they're talking about. And if they say, oh, it's all priced in, it covers up the fact that they have no idea. Right? So you got to be careful. For example, you cannot make money trading the financial markets because everything is already priced in. Oh, well, you should just quit. If that's true. And you hear this all the time. The market is so efficient that there's no ability to arbitrage. What's arbitrage? Well, being long one asset and short the other one at the same time. Because everything is so efficient that if there was a differential and an opportunity to make money, it would be immediately filled and therefore never exist. Well, then you can't make money as a Forex trader, is what they're saying. Because everything's priced in. Everything's perfect. They call this efficient market hypotheses, efficient market theory. And I disagree with it because I think much of the time humans try to be rational, but most of the time they struggle with it, and some of the time they're completely irrational. And we're in a situation where the Fed says, we will not cut interest rates this year. They've said it that direct twice. And yet I can go through this and show you that cuts are priced in. Is that rational or irrational? I think that this inefficiency, right? Like what I was saying before, 98% chance the Fed pauses. So let's highlight that, okay? Here's the pause. So if the Fed raises in June to 5.25 to 5.5, guess what happens? Holy smokes! 98%. And this, by the way, this is smart money. This is banks essentially trading the money market with each other. There's a private market for banks to lend each other money for overnight deposits, short-term loans. This is a facility for banks to lend money to each other, banker to banker. It's not public. They're not selling it to some idiot retail trader making a giant mistake, right? They're not, it's not like a sucker's bet. No, this is JP Morgan lending money to Goldman Sachs. It's smart money, right? And so what they're doing is in these negotiated contracts, they come up with a price. Here's the average price, 94.93. Okay? I will lend you $94.93 but you have to pay me $100 back. It's convoluted, right? Why not just pay you more at the end? Well, this is how it's done. All right, so think of this. Goldman Sachs lends Bank of America $94.93. And when the loan comes to maturity, they pay Goldman Sachs back $100. So do you understand there's an implied interest rate? So you start like, wait, they're gonna make some money here. They're gonna make $5, right? $5.07. So you reverse engineer it and you figure out what interest rate they negotiated. Cool, right? This is real money, real contracts. This is not an opinion per se. This is reality, real money, real contracts, real deals. That's what's happening in the market. They are pricing in that interest rates will be the same on June 14th. Cool, right? So if they're wrong, then they're wrong. All we know is that's what's happening now. And it's so heavily one-sided, it's either obvious the Fed's going to pause, and I'm not disagreeing with the pause, but what I'm saying is if they hike one more time, be ready for a financial tsunami of repricing because this is the wrong price. $94.93 if the Fed is hiking on June 14th is the wrong price. Now, a couple of days ago, 2 or 3 days ago, I think this was like 12%. And then I think a day ago it dropped to 6%. And now today it's 2%. These are idiots, knuckleheads, that believe the Fed's going to cut interest rates now. Cut. They're like, they're not going to pause. They're going to cut. Now just think of it. This was basically 10% very, 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 very recently. And you have to think about it where the Fed says, we're not even going to cut this year. We're not even sure we're going to pause. And these guys come out and say they're cutting. How dumb do you have to be? Well, whatever. There's a sucker in every market. Even smart money can be dumb. You just drive a nicer car and have nicer cufflinks. They're not doing their work, and I believe they're negligent, Mark. I'd be like the boss that says, can you come into the office? Yes. Well, the thing is, I've looked at some of the contracts you've been signing with other banks, and well, the way that you're pricing these negotiations, it kind of looks like that you think they're going to cut. Oh yeah, they're going to cut. They're for sure going to cut. Yeah. We need to go down to the HR office and talk to the outside consultant about about I don't know. Anyways, you're fired. That's how they say it. Right? Anyways, you're fired. Like, whoa, dude. The Fed's saying they might raise, and they're definitely not going to cut. And you're like, no, they're definitely going to cut. They're not even going to pause. You're fired. All right, so let's add some time, by the way. Yeah, let me show you the view from the rooftop deck. Look out, it's slippery over there. It's slippery. Yeah, Thiago, those old stories of like, that I've told at FX Bootcamp. I used to actually have an office. My first office was on Market Street. I believe it was 555. No, that was Montgomery Street. Market Street. So I was on Market Street, my very first office. And then my second office was up a few blocks and to the left and was on Kearny, which is right between the financial district and Chinatown in San Francisco, which is really cool. And I was in this very, very, very old building. It was very, very cool. It had a birdcage elevator, like crazy, crazy cool. But building codes were quite different back when they built this old building. It was amazing. So I had this view over Kearny Street and the Bank of America building. And I could open the windows in my office, like literally open them up. So obviously I'm not in a skyscraper, but you could open them up almost like shoulder high. The windows were so big that you can open the lower window and it was shoulder high. But the bottom of the window, the threshold of the window, was like 6 inches off the floor. Like if the window was open and you were walking by and you're not paying attention, you could trip and fall out the window. You're like, what? Oh, I fell out of my own window. Right? So you could just see like, that could be part of the HR strategy of, whoop, oh no, he fell out the window. Oh, well, I guess we're going to need a new economist. Can you imagine building windows where some person could literally be pushed out? Now what they do is they build a window and they give you a little crack so you can put your mouth against you can try to get some fresh air, because you never know. Somebody might hurt themselves. Anyways, let's add some time to this analysis and look at this. The price is different. Again, smart money negotiating money, contracts going out to July, and it's a different price, which means there's a new implied current interest rate. Okay. Banks are lending another bank $94.96. And when the loan comes to maturity, they have to pay $100 back. They get $94.96 today, but in the future have to pay back $100. The implied interest rate now has shifted and the distribution is changing, right? And what we're looking at is this is where we are expected to be in June. June 14th, that's where interest rates are supposed to be. According to the other one, 98% chance we're here. So I'm just anchoring. This is where interest rates are supposed to be on June 14th. It's where they are today, actually. This is where they are. So June 14th is a pause. So now that at the end of July, we'll still be here, still paused, but only 50% of the market. Oh my God, 49.4% of the market believes a cut will happen. Now, let's put this in context of today. Nearly 100% chance of a pause in June. And 50-50 chance of a rate cut. Cut! In July. And the Fed has told us twice in plain language, we are not going to cut interest rates this year. And 50% of the market says they're going to cut in July. July, it's May. May, June, July. Like, what are you talking about? The Fed said this is, right? Let's put this into context. The Fed says this is definitely not going to happen. All right. What is the chance that those guys are wrong? Is it significant? Is there a significant chance of being wrong? Type in yes if you think there's a significant chance. I don't care what your opinion is. That's not the point of whether you think they will or will not. Is there a significant chance that these guys are wrong? Half of the market. Type in yes if you think there's a reasonable chance. Reasonable. There's a probability that the market is inefficient right now. That this is priced in, but you're like, really? 50% of the market is betting against what the Fed has told us to be factually true. They're betting against the facts. Well, that would be market inefficiency. And this is where you make your money. If the market was correct all the time, okay? If the market was correct all the time, if this data was correct all the time, then efficient market theory would be correct, where nobody can ever make money. Nobody ever has an edge because the market is right. But I have this idea that people is smart. See, it's positive. I used to say people is stupid. When somebody corrected me, like, dude, it sounds like you're a jerk. And I'm like, well, okay. People is smart. Now, and I even think that's even funnier. People is smart. These guys may, in my opinion, probably are wrong. And that's where I'll make my money. That's my alpha. I'm not trying to outsmart the market. Okay. I just think they're probably wrong. And at some point, I can twist my trading strategy toward this. If we're pricing in these cuts, that's probably dollar weakness. And as we move closer and closer to the July 26th meeting, this is going to, if they start to realize they're wrong, because we're learning more and more and more, they're going to move back this way. So they've already done this. This is not an opinion. They've already negotiated that in, and that weakens the dollar. So if they are wrong and they start to discover they're wrong, they're going to shift and, right? Let's do it this way. They're going to shift and this will fall and this will rise. And that would bring dollar strength. Okay? Okay? So we have to be smart enough to understand the context of what would make that happen and not bet on it before it's happened. So imagine this, non-farm payrolls comes out and it's 300,000. Should the Fed cut in July? Huh? What do you think? If the number came out 300,000, should the Fed cut? Remember, they said they're not going to cut. So would they step on their own toes and cut? No, it'd be outrageous. So what would happen? This would fall, this would rise, dollar would gain strength. Because they would say, oh my God, we were wrong on this, and we need to move over here into this camp. So we'll stay paused and no cut, no cut. The pause isn't even the question now. It's either cut or no cut. Okay, you see? And that's what we're going to watch today. Now, if NFP comes out 89,000, yeah, okay, maybe this shifts. Maybe this shifts. And people are like, yep, definitely gonna, right? This is the beginning of the end. Boom. And so we expect, I think FXstreet said what, $1.89? $1.89, I think it was. So, anything around 200, nothing happens. If it's closer to 3, dollar gets strong. If it's closer to 1, dollar gets weak. You got it? You get it. You got it. You know it's good. My rhymes are tight. You wish you could. I went to the locker room during classes. I broke into your locker and I smashed your glasses. Yeah. Yeah, hey, you got to have a passion for what you do. I love being a Forex trader. Thank you for being here. Thank you for being with Trade Non-Farm Payrolls Live for the 205th month in a row, more than 17 years. Thank you for being a part of the FXstreet community. Thank you for being part of the FX Bootcamp community. Thank you for checking out Trader's Way. Thank you for all the positive energy you put into this and all the hard work you put into this. Let me tell you, as a former venture capitalist and high-tech entrepreneur in the Silicon Valley, I've looked at thousands of business plans and hundreds and hundreds and hundreds of patents. There is no better business than the one you're in now, called Forex. This is the best there is. Stop looking for something different. 253, thank you. And yeah, that's not low. Not low. Not low. So we'll watch how this changes. That is not low. So let's get go to the Bureau of Labor Statistics, otherwise known as what I call Bliss. If you're a Far Cry 5 person, you're like, I love Bliss. Okay, so let's take a look at it. This is really, if you Google non-farm payrolls report, there isn't actually something called non-farm payrolls report. It's the employment situation report, and inside of that, there's two reports, the household survey and the establishment survey. So there's a couple of things in here. So let's break this down. So jobs went up 250,000 in April. Okay? And we're still stuck at 3.4%. This is not showing that the Fed's policy is working. It doesn't say, oh my God, slash interest rates, forget the hikes, forget the pause, cut, 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 cut. It doesn't say that at all. It says, dude, if you don't want to cut, don't cut. You don't have to cut. So we want to watch this. If this falls, that's going to bring dollar strength. Or maybe it's easier if this rises. So we're at 50.5. If we're on our way to 60, that's dollar strength. Just so you know. Okay? So pay attention. Okay. All right. Professional and business services, healthcare are doing great. Leisure and hospitality are doing great. Social assistance, everybody's doing great. Except maybe what? Housing? But you know what? 6 months ago, maybe a year ago, I invested into the housing market. At the time, it was the worst performing sector of the S&P 500. Real estate builders, home builders. And the stock prices were so low that the value of the company was worth less than the book value of the company. Which means if you added up all the assets that they owned, you bought the company for less than the value of the assets. So you got a discount. So I invested, and it's up like 25%. Yeah. You're like, wait, dude, what? You're up 25% for the year on that? Yeah. In a down market. Yeah. Cool. Right on. So kind of interesting, right? So, look at this. They actually define this. The household, right? The news release presents statistics from 2 monthly surveys. The household survey measures labor force status, including unemployment, by demographic characteristics. So they go to the house, they ring the front door, and somebody answers the door. And they're like, hey, do people here have a job? Yeah, we have a job. Thank you. And then the person keeps talking. Yeah, but the problem is I'm underemployed. I have a PhD, but I'm making sandwiches at Subway. Oh. We're not interested in that information. Thank you. And off they go. Or the person at the front door is asked, do you have a job? And they say, well, actually, I have 3 jobs. I'm a lunch lady at the high school. After work, right, or before work, I work at a childcare facility until lunch, and then I zip over to the high school, and then I do a lunch lady stuff. And then nights and weekends, when I can, I do some Uber. I'm an Uber driver. And the surveyor's standing there like, what are you, a knucklehead, babble mouth? Like, that's not the question. Do you have a job? Yeah, I got 3 jobs. Yeah, okay, great. So you have a job. Click, and they leave. You see, like, it's incomplete information. So that's why there's 2 surveys. Then you go over to the establishment survey, and this is where they go to businesses. So let's say we pick on the local Subway sandwich restaurant. They go there and they're like, we want to look at your pay stubs. Payroll stubs. Okay? Now, this is where they might count you if you had 2 or 3 jobs. But remember, they're not sampling every company in America. If they did, they would get to know everyone's double and triple job. But they don't get that, but they do just count the pay stubs. Again, they're not asking, are you overemployed? Are you underemployed? You know, like, do you have a PhD, but you're making sandwiches? Again, they're just looking at the data and they're like, yep, okay, so you've hired these people. Okay. Food and services, right? Bars and restaurants added 25,000 jobs. Okay. But it doesn't tell you who's doing the job. Okay. That kind of stuff. You see the difference? And you add the establishment survey, which is a business survey, or the household, which is a personal survey. And then they use some fuzzy logic. They only interview a few thousand people in businesses. It's not a big survey. And then they go, hocus pocus alakazam! what was it? A la peanut butter sandwiches. And they come out 253,000. Okay, and that's why you get big revisions, huh? Nolan says, what's the next U.S. bank to collapse? Well, actually, I think today's going to be a big regional bank rally day. So I think they're going to be up today, but next week could be, back to the same thing. What's the next bank to collapse? The theory is, as yields come down in the treasury market, there'll be less and less crisis. Okay, because they're not mark to market, and if they are, they shouldn't be, and that's a whole different problem. But like, if we look at, I have it turned off. Cool. Sneaky. I've built a tool to do this a little bit better than what shows here, but I haven't released the tool. Or did I? No. All right. Well, you'll get it. It's coming. I've already built it. How interesting. I got to check, or am I just brain farting? No. All right. Cool. I haven't released it yet. I got a cool tool to give you. All right. So anyways, what I want to look at is the trend. Not what should happen, but what is happening. And that's the -2. And what that says is the technical trend on yield for the 10-year T-note is down. We were around 4. Now, currently, right now, we're at 3.35 and continuing to fall. Okay? 7-day projection is yield is getting, right? Best case scenario in this down move is it drops all the way down to 3.18. But that's only a 7-day projection. It could go further. So let's just say yields in the United States on the 10-year T-note have dropped from about 4, and it looks like they're on their way to about 3. As that happens, you have to understand the value of the underlying treasury is going up. And these banks, these regional banks, are holding portfolios of 10-year T-notes. And the 10-year T-note market right now is in a rally. It's bullish. You see what I'm talking about? So as the 10-year T-note market continues to be bullish, then regional banks are in less and less trouble, less and less vulnerable to a bank run. Because the value of those underlying treasuries is going up when mark to market. What the hey? Oh, I know what's going on. There you go. So, for example, okay, you have assets. Oh, there we go. Okay, you have assets and you have liabilities. What do we call this? What do we call this? Balance sheet. Nice. Yes, a balance sheet. Okay, so this bank has deposits of $1 billion. Is this correct? Is that a liability or an asset? A client has given you $1 billion in cash. Is that an asset or a liability? Do I have this right or do I have this wrong? Yes, it is both. So 1 billion in cash is 1 billion in cash, right? So let's let me try to organize this a little better. So we have 1 billion, and let's just label this, okay, in deposits. And it's a liability because the client, the customer, can come in at any time and say, I'd like 1 million of my money, or I'd like all 1 billion. I want it back. Or, you know, and you have to give it to them instantly, on demand. Okay? So, right? So this bank has $1 billion in deposits, which they have to make available in real time to any client at any time. Okay? So a run on the bank is when everybody wants their $1 billion all in the same day. Ooh, bad day for a bank. Now, currently, okay, they have the $1 billion in cash. So $1 billion in deposits and $1 billion in cash. Cool. Now, does a bank make money on this? No. In fact, they have to pay some interest on the deposits, so they would actually lose money on cash. So the banks have to follow certain rules. And this bank says, we're going to put 500 million and convert that into what? What do banks do to make money? Give loans. Okay, so now they have a portfolio of 500 million in loans. So how much is their cash? $500M. Okay. But now they're not making as much money as they could because they still have too much cash. But they got to keep something around for a while because people might show up and say, give me my money. Now, as a bank manager, you're thinking like, what's the likelihood half my customers show up and say, give me all my money? You're like, it hasn't happened in 100 years of this bank being in existence, right? So you're like, I ain't worried about that. But you still have to have liquidity. A loan on a mortgage is a 30-year loan, and it's not very liquid, really. Now, in modern times, it's more liquid than it's ever been, but it's really an illiquid asset. So instead, the bank manager says, well, I need to earn money on my cash. I don't want to loan all of the stuff out to mortgages because I got to keep some around. So I think what I'm going to do is I'm going to buy treasuries. I'm just going to put bonds because it's less letters. Okay. Okay, so the manager now could say, I'm going to be prudent and buy $400 million in U.S. treasuries, not corporate bonds. I don't think you can do corporate bonds. And so now this drops to 100. Do we have a balanced balance sheet? Sure. Yeah. So over here, you have bank capital now. So let's say these bonds are paying on average 4%. And these loans are paying 4%. Okay, bonds are paying 1%. Okay, sweet. But you're paying these guys 1%. So now the profit flows, the 4% of all of that flows to the bank as profit. Or revenue, let's call it. Okay. All right, so but then things change, and all of this was done when the Fed funds rate was at 2.5, let's say. So now the Fed raises interest rates from 2.5 to 5. They do it quickly. Okay? They do it quickly. Like you can't adjust. It's not a variable you can adjust. Okay? So in economics, we call that short run. Okay? It just happens so fast that you still have the same portfolio. What it means is if you ever had to try to sell this mortgage, let's say, the average mortgage is $1 million. If you had to sell this mortgage and the new mortgages now are at 5.5%, your $1 million average mortgage is only worth $800,000. So you're not willing to sell it because on your books, it's 500, you got 500M. But if you had to dump them today, you might only get 400M. You just lost $100 million. Where does the $100 million come from? Bank capital. And now the bank loses that profit. If bonds went from 1% to 4%, the value of this bond portfolio falls, and it's the most liquid thing and produces the least amount of income. Oops. Let me put that back. Oh, I've lost it. All right, so anyways, bank capital is down here. This is the most liquid, least performing. You're only earning 1% on these bonds. Why only 1%? The Fed lowered interest rates down, 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 down. And in our reality here, remember, the 10-year T-note really was only paying 1. So in this example, it looks like the Fed's already raised from 1 to 2.5. But the thing is, for a very long time, almost 10 years, the Fed artificially pushed interest rates down to 0, which means the yield on their 10-year T-note artificially dropped below 1, and yet banks are only allowed to buy treasuries, these bonds. It's the only thing they were allowed to buy, or they had to loan the money out. But we were in financial crisis. Either the 2008 financial crisis and real estate was underwater and people were not, asking for loans, or later on during COVID, even if you wanted to buy a house, you couldn't leave your apartment. You had to wear masks and bunny suits, and people didn't want to meet you. And they're like, well, do you want to do a virtual tour of the house? And so all of that really, really slowed down. There wasn't demand for loans. So even if a bank wanted to lend out, no one wanted the loan, but actually they didn't want to lend because we're in the middle of a zombie apocalypse as well. So they tightened their purse strings. They didn't make loans. So what did they do to make money? The only thing they could do, according to bank law and regulation, and that was take all their money, or nearly all their money, because they weren't loaning it out. Oops. And in this case, have 900M in bonds, paying 1%. Well, they're trying to make money. It's the only way they can make money right now, right? Or back then, a year ago, 2 years ago. It was the only way they can make money. It's not much money, but look, they got to pay salaries and pay rent and all that. That's how they do. That's what a bank do. So nobody wanted a loan. So they had to put it all in bonds, paying 1%. So now the Fed raises up and up and up, and now we're at 5%. In 1 year, guess what? This $900 million portfolio is what? It's 900 on the balance sheet, but if they had to sell today, they would get 400 million. And they would lose $500 million. And there's no bank capital anymore. They haven't been making money. And the money they've taken already has come out of these falling bonds. So they're like, okay, this is only on paper. This loss of 500 million is only if we had to sell it. But we have they have old loans. So it wouldn't be this bad because they'd have old loans, right? So maybe this is 7, and then the old loans, right, are 200M. But remember how low mortgages were? You know, the average mortgage in the United States is below 3%. But if you wanted to refi or buy a new house, it's 6%. So it's just not going to happen. Nobody wants to do it. You're not going to buy a house. You're not going to sell a house. You're not going to refi. You may never refi ever again. Because think of it. Interest rates will have to go actually negative for a mortgage to be lower than it was. Okay? But the thing is, these loans are worth less. Because they could have just, instead of loaning it out for 3%, they could have just bought a 10-year T-note today and got 3.5% and have no risk. I mean, there's risk of default on these mortgages, right? So they're like, oh, you could have just taken the money, had no risk, had complete liquidity, and earned a higher yield. So these these loans, if they had to sell the mortgage to somebody, nobody wants these crappy mortgages paying 2.8% and have default risk and illiquidity. They're like, screw you, I ain't going to give you full price. There's no way. I'll give you 40 cents on the dollar. How about that? Okay. So anyway, so a bank manager says, well, this is all on paper. But then one day, there's a run. Silicon Valley Bank. On one day, the depositors say, give us our $1 billion back. Oh, well, we only have 100 million in cash. And the bank capital is gone because we've already depleted any profits we've had has already been depleted on other forced sales. Smaller forced sales, but they've been taking small losses as deposits came in. And then word on the street got to the point where like, hey, did you know they're low on bank capital? So then depositors are like, really? And then all one day, the $1 billion show up. Remember, you're required by law to give them their money now. All right, sell the bonds, sell all 700 million in bonds, and you get yourself 400M. You got 100 million in cash. Okay, go to the secondary market. We have $200 million in performing loans. These are mortgages. They're perfectly fine. Dump them. Okay, you get 75. So now you have $575 million. You've converted your portfolio into cash and you're a little bit short. $425 million short. And the bank is insolvent because the bank doesn't have it. These loans were risk-free. These bonds were risk-free. And these mortgages were performing. People were paying their mortgage and they were collecting yield or income every month. Boom, 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 boom. Everything was working fine. The only thing that happened is, right? Depositors asked for their billion and they were forced to sell at a loss and they're out. What do you think about that? That's the banking crisis right now. The issue is the Fed had interest rates at 0 and the yield on the 10-year T-note was 0.75. And there was no market to make loans. So the only thing a bank could do is buy bonds, guaranteed by the US government, considered to be safe, risk-free, in fact. Risk-free. Does it mean you can't lose money? Oh, no. You can lose money. The risk is if the United States has to pay you back, they can raise capital, they can raise taxes and pay you back, or they can just print money and pay you back. But they will pay you back. That's not the risk. But you can see the value, the net asset value of the portfolio could drop when marked to market. You can hold to maturity and be fine. But there could be better investments. So when suddenly the Fed took interest rates from 0 to 5, everything that the banks have been buying for the last 10 years has become nearly, I wouldn't say worthless, but let's say 25 cents on the dollar. And is it the bank's fault? Well, they could have hedged, but they're earning so little money that the money they're earning would have all gone to the hedge. So I think that's where banks are like, well, maybe we won't hedge. Maybe the Fed will cut. Tisk, tisk, tisk. Okay? But you could argue that we shouldn't have been at 0% interest rates. And if we were going to go to 5%, we should have gone very, very, very slowly so that when you have this balance sheet, so if we go back to the balance sheet, okay, so now you got this balance sheet. And what you do is under the subcategory of bonds, what do you have? Let's do it this way. A 1 year, 2 year, and 5 year. And you don't buy the 10-year at all. And so 1/3 is in 1 year, 1/3 is 2 years, 1 year, 5 years. And these ones, after 1 year, mature, expire, they go off your balance sheet, they turn back into cash, and then you buy a new 1 year at the new rate. Okay, it's a capital stack. And then these other bonds, okay, they might pay a higher interest rate in year 1, and you hold it for 2 years because you like the higher interest rate. But after 2 years, there's a new higher rate because things are normalizing. So you get out of those low performing assets, but you don't sell them in the market. They just go to maturity and you get your money back, and then you reinvest at the higher level. And you're always kind of getting the current value. And you're not actually taking the paper loss because you're guaranteed to get all your money back. You see? And if they had gone slowly, well, these ones on paper would have lost money for a little while. And then they would mature and you get 100% of your money back. And then you buy a new one at a higher rate. What's the big deal? And then after 2 years, these ones will have lost value, but you get 100% of your money back because that's just mark to market. But if you're holding to maturity, it's irrelevant. It's only a paper loss until you get 100%. So you get no loss. And now you have all your cash back. You earned your yield. And so then you buy the new one. You see, and if it went slowly, you're able to just manage your capital stack and you're totally fine. It's the fact that we went from zero to hero in 1 year, then all of this went worthless and none of it you can sell. Especially in a bank run. Okay, so I think the Fed could have moved earlier, could have moved slower. Imagine we just went 25 basis points and we got to, let's say, 3.75, because I remember there was a time when we thought that's when the pause. Remember back then, there was like 100% chance of a pause. They were wrong, yo! And that's what I'm trying to get across. Smart money can be wrong. But you remember, let's say the Fed got us to 3.75 slowly. Let's say that took a year and a half. Okay? And we get to 3.75. Then there's a pause. Okay? But we're doing quantitative tightening. Remember that? And we do that for years. I think we would have gotten to the same situation of falling inflation when inflation has improved, but we wouldn't have a bank crisis. Okay? Because the banking crisis came from how fast, two things. The Fed forced banks to buy treasuries yielding almost nothing. And then two, they raised interest rates so quickly that they essentially made all the banks in the United States, because they bought all these assets paying nearly nothing, vulnerable to insolvency. Not because their clients are bad clients, not because their loans are bad loans, not because they bought risky assets. No, they bought risk-free assets. Banks did everything that banks are required to do. But the Fed made them vulnerable, right? Through raising interest rates too quickly, and previous to that, forcing banks to load the boat on worthless assets. That's kind of the problem, don't you think? So they could have just got us to normalize, let's say that's the neutral rate, allowed the supply chain to fix itself, which is disinflationary, remove the free money from the economy, and then remove the COVID money from the economy through quantitative tightening, okay, which also removes money from the economy, which also slows the economy down. Yes, we would have higher inflation for longer, but I think we're going to have that anyways. So I like to pretend. I'm an only child. I like to pretend. If I was the president of the United States, right? Well, if I was chairman of the FOMC, that's how the Wayne do. I would have focused more on QT. Okay, thank you, Jim. And this is what we're talking about now. Okay, an hour ago, we had people pricing in a cut, and I said they were stupid. I don't like to call people stupid, but right? But I hit that hard. I'm like, that's dumb. Okay? Then we had non-farm payrolls come out. And what's happened? There's no chance of a rate cut. They've lost money. They're out. They got stopped out. Lee-hoo, sir. And now there's a 4% chance of a rate hike. And what do we do? What we've done is in a normal distribution, I can't draw it because there's no cut anymore, but in a normal distribution, it would look like this. I mean, hang on. Let me erase this again. Hang on. Let's try to make it less confusing if we can. Wayne, can we make this less confusing? Sure. Okay. By the way, are you guys having fun today? Yeah. Are you having fun tonight? Do you Wang Chung tonight? Okay, so we'll look at this. All right, cool. Harvey always has fun, though. That's the thing. All right, here we go. A normal distribution would look like this. Let's say most people say pause. Some say raise. Some say cut. Okay? But most people say pause. Okay. Now, it depends how many people say cut versus how many people say raise. And I explained this before. I just wanted to explain it. I explained it before the news. Now I want to explain it from a different point of view after the news to make sure everybody understands, right? So we had a very good non-farm payrolls. I told you that would shift things. Okay, from cut to hike. I was 100% correct. Thank you. Thank you, ladies and gentlemen. Thank you. Oh, you're far too kind. You're far too kind. So what happened is we had this the shift in the distribution. Before NFP, okay, we had a left skew. Skew. Wow, how do you spell skew? S-Q, wait, S-Q-U-E-W? S-Q. What did I do, Wayne? There we go. S-Q-U-E-W? No, S-K-W-E-W, I think. Hang on. Oh, and I did the same mistake again. There we go. I'm going to put a K. What do you guys think? Oh, yeah, you do have it. Yes, it is. Sorry. It's not a word I spell that often, right? All right, left skew, which means in this distribution before the news, most people thought pause, but there was a left skew. Some have already priced in a rate cut, and that's bearish. No, it's not very bearish because most people are neutral. Okay. But then I said, if the news comes out good, it's going to turn to a right skew. Okay. And that's the basis of a strategy. Okay. Now, what we're studying is kurtosis, where you're looking at not only is there a left skew or a right skew, but is this a fat tail or a thin tail, or is this a fat tail or thin tail? So the more people that think there's going to be rate cuts, the fatter the left skew, the fat left tail. The more people that think right. So now this is totally right skewed. And I think that makes sense. I mean, it's logical. We already talked about it. Shoot, now once again, I killed that. Okay. But so now there's a right skew. And the next thing is how many people become in this camp. And the more and more people, so this, let's say this goes from 3% to 23%. Then your new distribution looks like this. Nobody thinks this, then it spikes up. Most people think this, and now the new skew is more like that. It's a fat right tail skew. Kurtosis. kurtosis. Anybody know how to kurtosis? Kurtos. Oh, Google changed what I was spelling. Kurtos, O-U-S, right? Courteous. Oh, man, I'm spelling it so bad it keeps... Kurtosis. Kurtos. Us? I can't... It's too... I think it... I'm spelling it too poorly. And it's too... Oh, maybe that's what it is. I'm spelling it with a C. Kurtosis. Okay. So, okay. You guys like this stuff, right? You love it, right? You loving it? Okay. Kurtosis is the measure of the tailedness of a distribution. Tailedness is how often outliers occur. So we're looking at an outlier. Cuts were an outlier. Now we're looking at hikes. It's still an outlier outside of what most people think. But how much kurtosis do we have? Excess kurtosis is the tailedness of a distribution relative to a normal distribution. Distributions with medium kurtosis or medium tails are mesokurtosis. Distributions with low kurtosis are, yeah. Anyways, I think, was my explanation understandable? Because I think if you showed this to most people, their heads would explode, right? Okay. Did I just teach you this in a way that makes sense? Okay. All right, so the question here is generally, how is the dollar affected by NFP news? I just explained it using statistical analysis. I just explained the whole entire thing. Okay. Huh? What do you stink? Awesome, right? I mean, seriously, you're going to be able to do this now, right? I'm going to do one more, and then I have to actually leave early today. I apologize to that. I do have to leave early today, so I apologize for that. But you notice that part of this is standard deviation, because we're looking at this distribution and we're trying to say what's normal, right? Isn't that the question? So what's normal? What's the standard deviation of what most people think relative to what people think good or bad? Okay? So that's the standard deviation. And then how different is what we have, negative kurtosis or positive kurtosis, right? In this case, what we're actually looking at is this, the right tail, and how the shape of this distribution is changing. For that, you're going to need a standard deviation. Okay? All right. So one of the things I had to do at Harvard was they give you this distribution, this data set, and they say calculate standard deviation. So let's do that. The first thing you do is it's almost like creating a moving average. Right? And you kind of, let's say there's a moving average in there. So you take this average and then that average with that average and then that average with that average with that average with that average, blah, 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 blah. And what you find is, okay, it starts to look like this. This is the average mean of all these prices. So you take all these averages and it starts, okay, so these are pulling it down, these are pulling it up. And over that time, you get an average of the distribution. Then you do rise over run. Well, actually, let's do the formula. Y equals mx plus b. Mx plus b. Now, notice that we have our axes, right? There's our vertical axis. There's our, right? Okay. Y equals mx plus b, okay? We have our y and our x axes. B is the intercept. Okay, so we have that here. There's the intercept. So that's B. Y and X is already there. So all we have to do now is calculate M. And M's formula is the rise over the run. And that gives you slope. So not just the average price, but how much, and is it sloping up or sloping down? Is this bullish or bearish? Okay. And you get the slope of the average price. Plus, you already know the X and Y axes, and so it's crossed above, so you know that. And then you know the intercept, where it crosses above with that slope, and you calculate it. So this is bearish. This is negative slope. Okay, great. But that's not what we're interested in. We're interested in standard deviation, or right? So anyway, so now we have all our variables figured out. And now what we need to do is say, okay, how far is Aussie dollar from the average price? How far is Aussie Kiwi from the average price? And you start with all these negatives, negative, okay? How far away are all the asset prices below the mean? And you might get something like this. And then you look at all these things that are above the mean, and how far is the 10-year T-note from the mean? How far is the CAD Swissy from the mean? Okay, and you start doing, right, that, and you get variance. Okay? Okay, and very often the variances are quite different. So very often, in this example, they're like, let's say there's a couple of outliers that might pull this deviation slightly higher, this variance. The bullish variance might be different from the bearish variance, although this is impacting it too. So this has two outliers, this has one outlier. But anyways, so you look at the variance, and then you take the square root of the variance, and you get your standard deviation. And so now your standard deviation might look something like this. I'll have to do it in a slightly different color. We'll do it in this bluish color. And the standard deviation might be a little more like this. And this one's probably a little tighter than that one. And that one's a little farther than that variance. And now you have the standard deviation of this bearish right-tailed distribution. You're a bear. Okay. Oh, was it blocked the whole time? I apologize for that. But anyways, I'm showing you how, like what NFP just did. Okay. Yeah, I thought so. Thank you. So let's do this. We talked about the Fed policy, and what the Fed has said in the last two Fed meetings. And we looked at how differently the market has priced based on what the Fed has actually said. And then we talked about efficient market theory that you can't possibly make any money because it's all priced in, because it's all smart money. All the bankers are smart, so they can't get it wrong. Smart money negotiated with smart money. Well, instead, I look at a measure of what smart money is doing, and then we look at what the Fed is telling us, and then we look at what the smart money is actually doing, and we say, oh, wait, that's different. That's different. We have reality, and then we have what smart money is doing. And you're like, well, there's a reasonable chance that this smart money is wrong and that this idea of efficient market theory might be flawed, because now the market's in duress and the market's trading a theory, but it's not the reality that's being shared with us by the central bank. So there's a huge possibility of being wrong. So we got to that. And then you say, well, what would be a sign of they may be wrong? And I said, well, let's take a look at how NFP impacts these things. If the number is high, they're going to be wrong and they're going to have to reprice. If they're low, if the number is low, if non-farm payrolls is low, like 102,000, well, then they are right and they don't have to reprice. So the number comes out hot, 250,000. And I'm like, okay, look, that means that the Fed isn't likely to do what has been priced in. And that those people will have to reprice. And in that sense, we should be able to see it in the data. But that would bring dollar strength. So the number comes out hot, they do shift. So then I went back and I showed you the importance of this, and how we got there was explained before we even looked at it. So then we looked at it again, and we can see in real time what was priced in is being priced out. And I said, this is our alpha. This is our ability to make money, our careful analysis of the facts, not hypotheses, facts. And that the market was inefficient. The market was wrong. People are losing money, which is our opportunity to make money. So then we go back and I show you how to look at this distribution. We talked about the shift from a left skew to a right skew, and I taught you about kurtosis, and in particular, the meaning of these fat tails versus skinny tails on the various skews, which lead to bullish or bearishness, which lead to dollar weakness or dollar strength. And then from that, I explained how to look at a distribution, calculate the mean, calculate the slope of the mean, calculate the variance, and then from that derive the standard deviation. And now the stock market's about to open and I need to go. I have lawyers and stuff. I'm setting up a new hedge fund and just lots of crazy, awesome, amazing things happening in this world. And I wish I could stay longer, but I do have to bid you adieu. So I hope this was a valuable use of 2 hours of your life. I hope you got some form of return on investment, even if it's just entertainment or infotainment. If I'm just an infotainer, then maybe it's still a positive influence on your life. And maybe in a small way, joy and happiness. Wouldn't that be nice? So I'd like to thank FXStreet for being a host of this one particular webinar for 205 months in a row. But I've been working with them for nearly 20 years on a regular basis, which is pretty amazing. I'd like to thank our moderator, because nobody moderates better than our moderator. Nothing moderate about our moderator. We have the world's most extreme moderator. Moderators wake up in the morning and hope and pray to be half as good as our moderator. So thank you to FXStreet and the entire team there. Thank you for being part of this community. Thank you if you've been to, 200 of these events. Wouldn't that be cool? And I think some of you probably are pretty close. I know many of you are well over 100. So thank you for your loyalty and respect. And thank you for sharing all that positive energy so that I have the strength to get out of bed and do what needs to get done. I appreciate you, and I do think we do make the world a better place together. I tried trading Forex by myself, and let me tell you, it sucks. So, once again, I have a book I wrote many years ago. It's on Amazon.com, Strategic and Tactical Forex Trading. My community is FXBootcamp.com. 88 hours of training videos for $88 a year. QuantBox, we used a lot today to look at macroeconomics. It's all there, dude. It's doing all the work you need to be doing. Make sure you, if you don't know anything about QuantBox, go here and watch the video. It's great. I'm telling you, I'm going to show you how to do all of this for free. You don't have to pay money for well, you have to pay money for QuantBox, but in that video, I'll show you how to do it all yourself for free. Dude, like, awesome. And then tradersway.com, obviously, you need a broker. I believe Traders Way is a trustworthy, ethical foreign exchange brokerage for retail Forex traders. The moment in time that really earned my loyalty and respect is when the Swiss National Bank lied to the entire world, pulled the plug on their peg, and giant foreign exchange brokers went out of business. And apparently it's because they were holding the other side of all their clients' trades. And they went out of business that day. And I'm like, oh my God. So my Traders Way account was still working. So I contacted Traders Way. I'm like, how are you guys doing? How are you guys doing? And they're like, we're totally fine. I'm like, what do you mean you're totally fine? The Swiss National Bank pulled the plug. They're like, yeah, we saw that. Yeah, the volatility is crazy. I'm like, but you're fine? What do you mean you're fine? They're like, well, we execute all our trades into the interbanking system. We're not on the other side of any of this. I mean, we brokered, we matched them. Like, it's in the interbanking system. We don't hold any liability on that. We did what we promised everybody. And I'm like, holy Shazam. And other brokers are going out of business. And I honestly thought we were going back into another global financial crisis at that point. Big brokers were going out of business. Totally insolvent. Traders Way was perfectly fine because they did what they promised to do. And I said, thank you, Traders Way. And that's the moment in time they earned my loyalty and respect. So do your own due diligence. Go check them out. So those are all resources. And of course, spend tons of time at FX Street. That's where I started, and I recommend FX Street to you. So peace on earth. May the pips be with you. May your profits be above average. Have a wonderful weekend.